Hi, everybody. I'm Dale Pinkert, aka Coach at TradeGATEHub.com. And today I'm joined by my trading warrior brother, Peter Goodburn, who I consider one of the best Elliotticians out there on the globe. And, we want to take a little look ahead as we're coming into the end of the year. And it's interesting, Peter. Welcome to TradeGATEHub. Last year, everyone came in bearish the dollar, Peter. You looked at COT positioning, everything, and wrong-footed because we had this nice recovery from the 89 level. We've pushed up towards 96, and knowing your work, I know you always considered this a bear market rally in the context of a secular bear market in the dollar. And I think it could be one of the biggest surprises that people have already given up on. There you have a lot of dollar bulls out there right now. And I was wondering, Peter, everything, every day matters. Do you think what China did today with increasing reserves on foreign exchange was the first shot across the bow? Because the USD CNH has been under pressure, made new lows, and they're saying enough dollar strength against our currency at this point of time. Do you think that could be a foreshadowing of what's going to happen to the dollar in 2022?
Well, to some extent, yes. Anyway, good to be on this program. Thanks,
Great
Dale.
to have you, buddy.
Yeah, it's really great. And no, there's two parts to your opening remarks, really. One is the way that the dollar's behaved over the last year since the lows. Yes, you're right. We go wind the clock back to January last year, commitment of traders and whatnot. Very dollar bearish. But we could see that the dollar was heading up. And the other aspect with China, I don't know. I'm following the Evergrande news, with the property market in Hong Kong and stuff, and from the guys that we talked to out there. It's on a knife edge, really, whether or not there's going to have to be some state government funding. If you go to Shenzhen, across the border from Hong Kong, and you start talking to people there about the issue, they're quite convinced that the local government will step in and have an orderly wind down. But you saw Fitch today downgrade Evergrande, and also this Kaiser Group, which is the second largest property developer. They've both got overseas dollar lending, which they've been defaulting on. And I've got a feeling that really the authorities there, rather than looking at currency per se, are really probably just saying, right, well, we're here. We've been tightening for quite some time this year. That's caused the underperformance in stock markets, for example. And we're here to start showing the markets that we're actually aware of some frailties in the system, and we're here to support it if necessary. And that probably would go hand in hand with what we're seeing to some extent in the currency. Well, let's have a look at dollar RMB, because, yeah, to a large extent, when you start looking at these currencies overall, the RMB is really becoming more attuned into its reserve status almost, because in Asia, so much with the Silk Road projects and so on, we've really seen a lot of acceptance under the deliverable idea of a renminbi and a basket currency. And of course, it does feature heavily in the ADXY. This is the one of the, this is the basket currency for Asia. And the RMB makes up about 33 and a third, I think it's a third of percent, 33 and a third percent of the entire basket. So it is a big thing. I don't think that we're looking at any significant sort of decline from this particular juncture. As you can see from this weekly chart, gives a bit of a perspective of where we've come from and where we're going to.
So it's still in a bear market, and this would just be a bounce in a bear market for those currencies.
Yes.
Even though the dollar will also be re-entering a bear market, this stays in a bear market.
That's right. This obviously suggests that we're going to see some dollar strength against renminbi, but this is not necessarily dollar strength per se. It's probably renminbi weakness.
Right.
you know, because
Okay.
of the stance that the policymakers are making there. And so that
Well,
would get.
they want to keep things looking okay through the Olympics, don't you think, Peter? I mean, it's a major, you know, major event for them. There's already friction with diplomatic embargoes of it or boycotts of it, and they're not happy about this. You know, perhaps this is a, you know, kind of a shot across the bow that, you know, maybe we're not going to be dollar supportive anymore, which is
Well, I
what,
think I think that's certainly the case. I think at some stage next year, we're likely to see a bit of a dollar run, to be honest, because we've been building downwards on the dollar index for quite some time. Let's have a look at the dollar index on a slightly
okay,
larger perspective. And when you take a look at the dollar index over the longer term, here is the all-time high. It goes back to 1985. I mean, effectively, I mean, you know, even if you're not an Elliott Wave aficionado, you know, you just do technical analysis. You're going to draw a line like this, and you see sort of lower lows and lower highs, downtrend basically. But we're not used to thinking that of the dollar in a downtrend. But when you look at it historically like this, going back to that mid 1980s, you're in a downtrend. I think there's going to be a dollar run somehow next year. I don't know whether that's going to be triggered because we're just seeing burgeoning debt, and whether foreign nationals, foreign corporations, and sovereign wealth start to diversify away from the dollar, whether that culture will start to emanate. But it's certainly pictured in some of the cycles. I mean, if we go back to the cycle again from last year, this is the dollar cycle, and this is our daily composite. This is a proprietary combination of different cycles, and we've had some quite good success with this. Even during COVID, when the dollar suddenly zipped up because of the shortage from foreign banks, resulting in this high up here, just above 100. You can see the cycle was leaning, and of course there was divergence there.
right.
But it bottomed really nicely in January. So when the commitment of traders were all looking
Yeah.
at sort of dollar
All the dollar
oversold,
bears down there.
yeah, we had a pretty good idea that it was time for a rally. Of course, from an Elliott perspective, from the March 20 high, we counted down 5 ways into this January 21 low. So we had sort of 3 indications that the dollar was going to start a more robust advance. Now, at the time, when I looked at that, I thought, wow, this cycle doesn't, you know, it goes up for the best part of this year till October, November time, and it only then starts to turn down again. I thought, wow, we're going to be heading up for an entire year on the dollar index. That's
You
pretty
thought we
amazing.
would have made more progress, huh? Than we did? Because what are we sitting at now? A little over 61.8 back at the recent high that we've had here. So we've had a 1-year rally, and we're not even at 61.8 yet. That's up at your 98-ish level.
Yeah, well, I think I'm using a log scale, so it depends what you're using. But, you know, this is, just not quite at 61.8, almost thereabouts.
Okay. Yeah.
And, but, you know, that's a generally good point from which the dollar should start to turn down soon. I think we've labeled this advance as a double zigzag pattern. So we've got 7 price swings in here, 1, 2, 3, which is the first zigzag, X the intervening correction. Then you have another 3 price swings. And of course, each swing upwards, directionally upwards, is subdividing into 5 waves. And this final leg of the secondary zigzag is wave C. You can see subdividing into 5 waves. We haven't quite finished yet. We've got a little bit of a correction in the 4th, and then a 5th coming in. And then basically that's it. So we're a bit overdue in terms of the daily composite cycle. We're a few weeks late. And of course, you know, from this, we could roll into maybe early January before we hit 98 figure. But that's an acceptable deviation in terms of those timing cycles. What it does tell us, though, afterwards is that, you know, we're heading down in a big way. And we take a look at the slightly bigger picture. We go, this is good.
I like that. All right. So you're taking us back to 08. You actually have a slide that, but let's start here and then we'll go to the huge telescope, the one that NASA just launched to replace Hubble. All right, because I know you have a chart that goes back to when the dollar wasn't quite the dollar yet. But let's address this because, you know, I think that most, maybe the whole world, but especially Americans are going to be affected by this, Peter, because we've had inflation in food and everything and wages, and that's with a steady currency. I would think that a dollar decline like this for a couple years would just be gasoline on the fire for the dollar losing buying power, even if there wasn't a supply demand issue.
No, exactly. I mean, I think that this type of decline in the dollar will basically, inflate the debt out of the way, because there's no other way to really pay down the debt. Look at the amount of money that's being circulated at the moment.
It's a sacrificial lamb.
It is.
Does the Fed get this going, Peter, or is it outside where people go, you know what, you've been king long enough. You threaten us with not being able to use your SWIFT system, and that's really the leverage. And the Chinese have been developing their own, and there is a move away from de-dollarization is what's been the hope for a lot of these countries for a long time, possibly even the IMF with them preparing an SDR. Is this when Humpty Dumpty fell off the wall? And
yeah, I think that it'll probably be from overseas. I think that there's certainly a power transition going on. I mean, you can see it in the political realms with the United States putting pressure on foreign countries for maintaining dollar ties, and you can see how Asia, in its own reserve bank that it's created in the last few years, is trying to move away from dollar-denominated sort of fixings. You see it with this hot spot in Iran, for example, where the Iranians want to sort of start to price oil in different currency denominations other than the dollar. And ultimately, I think.
You know what happens when a country threatens the U.S. hegemony?
Well, that's right.
Normally.
And then I mean, if that is going to be threatened, which it is, I mean, that's even interesting why, there's such deep discussions going on between Biden and Xi Jinping at the moment, because, this is the Americans wrestling with the idea that the dollar is a currency which could be fading out of the way. It's losing its momentum that we've seen over many decades now, since the British pound was its old reserve currency and was displaced by the dollar. So historically we can look back at it and say, yeah, that's the way things go. And certainly the way that foreign policy is attuned, you can understand why a lot of different countries are saying, well, why do we still have that sort of dollar system? Let's create a new one, which has been created already in Asia.
You know why? Peter, excuse me. You know why I think this could happen is because the one note Charlies of talking about the demise of the dollar and the next big depression and crash have been saying the same thing since I've been in the business. And look at me, it's been a while. I've been in the business. The demise of the dollar, the end of it being reserve currency, that it's a story that's been, everyone's been waiting for decades to see it happen, and now they're jaded to it, because people have professed it for so long, singing the same tune. I bet there are a lot of people, when they look at targets like 49.35 in the dollar index, think, oh, come on. People have been talking about the death of the dollar forever. Do you know what I mean? That it's been beaten to death, this scenario. So,
well, it's a bit like the same thing in the stock markets, isn't it? There's always the perennial sort of bears out there, which are always saying, they want to be fatalistic and say, hey, the market's ready to crash tomorrow or next week or next month. And
they're the same people.
And they've been same people,
and buy gold at any price.
Well, that's right. It's because it's going to the moon.
Which is, don't wait to buy gold and wait.
Yeah, I know. And these, they're the gold bugs. The problem is with those sort of people, they've always got an investive bias. and we know that markets go up and down. So if you've got an investive bias at all in your genome, as it were, you're really at a big disadvantage from trading, because you just trade basically what you believe in, and if you believe in one direction only, the market's composed of two dimensions here, up and down. You can't just trade to one bias. So you've got to understand the rhythms, and the more you're in flow with those rhythms, the more you're able to sort of make better investment decisions, for sure. But at the moment, if there are still those perennial bears out for the dollar, well, they might have their day. They always
Every
say
dog does.
And a clock is always showing the right time twice a day, isn't it? Well, at least an old type of clock with hands.
Yeah.
Not a digital one, but
So I think the market's vulnerable to a move like this, because you probably have people as wrong-footed now as you did at the beginning of 2020, 2021.
Well, the other thing is that interest rates. I mean, really, we've seen what now 35-year decline in interest rates from the 1980s. So this is quite an exceptional period, and interest rates have gone to negative here in Europe, as you know.
Yes.
And this is something that you would never have believed in. I mean, who would have believed in minus $40 for oil last year? Even if it was momentary. But the fact is that interest rates have fueled a huge burgeoning of debt, both in the public and private sector, and it's difficult to know how to pay that down. I mean, we're now getting to sort of levels per capita and GDP levels where it's very difficult to pay back. I mean, and this has resulted in wars, in the past. Don't forget that Germany after the First World War was basically subpoenaed to and brought forward to back the Paris Accord, meant it had to pay back its for the First World War atrocities, and that's what brought
led to World War II.
Absolutely. So you can see that, and
so we need a jubilee and forgive all debt so we could have peace. Yeah,
it takes a lot of courage to write off a debt like that, but that's what's needed, isn't it? I mean, but that's really what it's out and about.
That's not going to happen.
Not really, not in this modern day. No, I don't see it.
All right. So my question is, some of these targets down here, obviously the euro is a big part of the dollar index contract. I'm curious as to, besides the euro, or we could look at the euro and what potential targets are for that. I'd also be interested. So, okay. So
this is the euro. I mean, we're seeing a snapshot really from 1920. We've got longer term data than this, but we're showing this particular pattern for those of you tuning in who are familiar with Elliot Wave. This is actually showing the secondary and the third final zigzag in a triple pattern going back to 1920. So the third and final zigzag begins here. This was shortly after the inception of the euro. We dropped down from this level, 123 down to 82 cents.
Right.
And then we're engaged in the final zigzag. So it's fairly basic in terms of patterning. This is not rocket science. You just got to learn some basics of Elliott and see what's happening. This is wave A, this is B, and we're gradually building up from this 103.41 low into another 5 price swing sequence.
Yeah.
So we've got targets probably around $2 to a euro.
Okay. All right. And I know that you're looking for a low coming up in Aussie. We've had a little bounce here in Aussie, but like you're saying, we could have an ABC in the dollar. You're looking for the mid 60s in Aussie, and then 87. Okay. All right.
Yeah, that's right. I think this is a fairly comfortable. I've actually been talking in our short-term reports that we published about whether or not the Aussie could actually stretch to 66, because it's not actually moving down as much as I would have liked. It could be shaved a little bit. For example, if we were to shave it slightly, I think I've got a daily chart here actually. Yeah, if we shave it slightly, we might get to 67.89. This is a 38% extension of this initial downswing of this zigzag correction. But overall, somewhere in this sort of price area here, you're going to hit a low, and and then we're going to start trending up again.
Okay, well, which currency during this decline do you think has the most potential fiat against the dollar? Is it the euro, or are there going to be some exotics that are going to way outperform maybe some of the emerging markets that have been under stress because of a stronger dollar because they denominated their debt in dollars? So if the dollar would weaken, you would think that that might be an area in the world that their currency could revalue.
Yeah, absolutely. Well, we're not quite yet ending what I term as the commodity inflation pot. We talked about this a long time ago because, well, it goes back a decade now, this term. So mainstream has gone through with this idea of inflation and rising inflation pressures right now. But we actually knew this was coming 10 years ago. The reason we had such a long-term outlook for inflation was because it actually occurred after the financial crisis decline. Back then, when you look at long-term commodities, you could see a five-wave structure from the 1932 lows, the Great Depression lows, right up into the peaks pre-financial crisis. So that's 2007. And when you have such a long-term uptrend like that, the correction naturally takes a proportional time to unfold, and sometimes corrections are what we call expanding flat patterns, where they. Let's have a look at one. Perhaps we can perhaps log into. Let's log into Wave Search, and I'll just show for everybody listening in what an expanding flat pattern looks like. But you get an expanding flat pattern. Basically, you get a slightly higher high. So this is what it looks like. This is where I'm pointing to now on this chart would be, say, for example, a commodity in 2007. And this drop down here would be the financial crisis collapse.
Yeah.
So this becomes wave A of this expanding flat pattern. But B is able to trade into a new record high before wave C collapses even lower. And we're engaged since the financial crisis. We're engaged in this B wave upswing. It's taking more than a decade so far. And it's got another few years to go. But that movement up hasn't finished. So when we talk about the initial phase of dollars declining next year, I think, yeah, you're right. The emerging markets, but particularly those commodity currencies, will look pretty good. So we can, what are they? Well, we can look at Brazilian real. We can look at the Russian ruble. We can look at the maybe the Mexican peso. Things like that. So if we take, well, the Aussie dollar, for example, well, let's say, yeah, we just looked at the Aussie dollar. Let's have a look at that. So on the slightly bigger picture, we're talking about really big gains like this going on for the Aussie against the US dollar, you see?
Yeah.
We're coming down to this. This is reaching 38%. We'll come down a bit lower, but then we go up, something like this over the next several years. And
triple.
Yeah, I mean, that's really where some of the big gains are. I like the Russian Rubble. Let's take a look at that. Yeah, that can drop dramatically. I mean, here we are hitting tops around the 85, 82, declining tops. But ultimately, this can drop all the way down to something like here and beyond, depending on the timing. I think this is a reasonable timing into this time period.
Well,
so
looks like they're, I would say that this bodes well for them annexing the Ukraine.
Well, I mean, probably, yes. I mean, there are talks about it at the moment. I mean, actually, some of our website developers are in Ukraine, so I'm talking to them quite a lot. I said, well, look, can you give me a quick text if the Russians cross the border? Because, I might put some trades on. Yeah. But no, notwithstanding.
That's a huge move. Wow. Huge.
But no, I think realistically, I don't know. I don't see that as any.
Yeah, it's not an indicator of foreign policy being successful or not.
No, I think
monetary policy.
I think it's a mixture of the commodities still doing well into the last phase of the inflation pot, and a mixture of the dollar, having a bit of a run on the dollar next year somewhere, and so I quite like that one. And then, Yeah, Brazil is an interesting one. These ones, the Mexican peso and the Russian ruble look as almost as if they've topped out. But I'm not sure about the Brazilian real. I have to say it's still looking a little bit weak, and our weekly chart looks more like it's topped out up at this 597 area. But I have got an alternate count which we've been playing around with to see what might happen. If worse came to worse and it broke up, it would probably trade up to about just about 7.
Okay.
Raise to the dollar, but I'm not sure about that. It depends on what it does in the next month around the new year.
So, with the dollar being weak, you could be long almost anything but debt, right, Peter?
Yes, I mean, I think so. I mean, obviously, it's a bit of a problem, isn't it? Because if your income is in dollars and you've got foreign currency to pay out, that's a bit of a problem. The real hit comes from the consumer in the US, because obviously that means higher import prices on a dollar decline and eventually higher inflation. So in other words, the dollar's decline, if we're correct on the assumption that it's going to trend down in a big way over the next few years, then of course that's going to exacerbate what we're already seeing in terms of inflation pressures. Now, notwithstanding that, I don't think inflation is going to continue in a linear line right now. I think we've got a bit of a pause coming.
With the break we had in energy being a precursor of maybe next year the Fed could say, see, it was transitory.
Yeah, I think the Fed, well, the Fed are doing funny things because at first they say it's transitory.
Yeah. Then they retired it.
And then
I've never been to a retirement dinner for a word. Have you?
I mean, that I tell you, they really are. They're sending me crazy because I was thinking, I think the Treasury yields will decline next year.
Yeah.
Looking at the 10-year break-even inflation rate, that's heading down next year. Yeah, the inflation pressure is going to have a pause. Hey, that's a bit strange. The Fed are saying the same thing. I better check all my analysis out because we don't want to be on the same side as the Fed. That's and then suddenly they change around to my relief. They started saying, hey, it's not transitory now, it's more persistent. So I was feeling much more comfortable with that because I couldn't figure out why my charts were telling me one thing and why the Fed was on the same side at first.
Yeah, it makes you uncomfortable now.
Yeah, I was thinking, well, from a contrarian
it used to be the public, now it's the Fed that makes traders feel uncomfortable.
Well, I think
Peter,
the last 3 Fed president chairmen have been terrible. I mean, they've just got no idea about how to sort of read the tape, because they're just being too much transparency, really. If you want to control money flows, you've got to be a little bit less transparent, and you've got to have a bit of forward thinking as well. I'm afraid the Fed doesn't have either of those qualities.
We need the briefcase walking into the Fed now. Alan Greenspan's briefcase, the briefcase indicator. No one knew what he said, even though they would shake their head and pretend like they did. He was a master at saying everything which meant nothing to everyone. So, Peter, a lot of people have gotten used to the guys that are looking for a correction in the stock market. And I know it's really tough to pick a top, but if any day it ever happens, people are going to think that the dollar is going to catch a bid, and because that's what they've seen is market up, risk on. But they can't say that this year because both the dollar and the market have gone up together. The dollar wasn't the wrecking ball that a lot of dollar bulls thought it would be. A lot of people are going to be surprised. Could we have a correction in equities and a falling dollar?
Yes.
Okay. And that's a different regime and a different narrative than we've had for many years, right? Or are people just misinterpreting it, thinking that flight to quality is by the dollar?
Yeah, well, I mean, we've had this conversation with many of our institutional clients, hedge funds, sovereign wealth funds, for quite some time. How can you be bearish for the dollar next year when you're also bearish for stock markets, which we are? And we think there's going to be quite a big swish to the downside next year as a correction to the post-pandemic advance. Now, how can you have both? Well, it's quite simple. This is this dollar movement up, particularly from mid-year this year, is not about safe haven attribute to it. I mean, don't forget the stock market's been trending up and still is near the highs, and yet the dollar's been trending up as well. It's all about interest rates and the reflation program. It's all, differentials if you like, but it's about inflation. I mean, whilst inflation is surging higher in an environment and in a huge economy like the US, if you've got inflation pressures running up, that's what's sending the short end of the yield curve higher. The 2 and 5 years are accelerating very, very fast indeed, causing the spreads, the yield curve to flatten. Right. So the 10s and 30s are flattening off, and this is all to do with the dollar's movement up. So the dollar's only going up whilst the 10-year yields go up. So if you know what 10-year yields are going to be doing, you know what the dollar's doing, or vice versa. And I can tell you that both suggest to me that the 10-year Treasury yields are still trending up between now and year end, early January. So we should have a look at 190 above the March high at 170%. And that will keep this dollar bubbling up to about the 98 figure. Now, when those two top out and Treasury yields start to drop down, so will the dollar. So they're going to be locked into a more positive flow for some time.
Okay, so very interesting. I think that's going to be a surprise for a lot of people, is they're going to be going to the dollar during the sell-off, and that's going to be quite a surprise. So any other markets? I'm assuming that gold will benefit from this dollar decline.
Yes, I think so, but gold is not quite ready yet. I mean,
just like the dollar isn't quite ready.
That's right. Whilst the dollar's going up and interest rates are going up, it's putting downside pressure on the gold.
Yeah, they really got to silver today. I think it's coming back, but we were down under.
Yeah, it's down at
22,
just 21.95 on my other system here.
Yeah, so it's leading the way down.
Silver's struggling. I think we got silver coming down to about 2060. Okay. I think we could do with a little bit of a short-term bounce higher, actually, but you see, this is gold having a bit of a rally. Gold looks to be in a bit of a triangle correction here. For those who know a little bit about Elliott, we're talking about decline from the August 20 high unfolding as a triple zigzag, and wave X is the secondary X in that sequence. Right. It's unfolding into a triangle pattern. So we've got down to 1720 up to 1845. That 1845 rally will then be followed by this final sequence down to about 1595. And I think once we get down here, this is a really great opportunity to buy gold. Let's call it 1600, because that's when we start to move up. Now, we've either finished the entirety of this decline as primary wave 4, and we start a new uptrend then, or we just range trade. I've got a few clients who we've discussed this about cycles and everything, and they tend to think that the 8-year cycle doesn't bottom next until this time, until later next year. So they're thinking that with that bottoming in 2023, that the next big swing up will occur for gold then. But I think you should be buying it. If we get to 1600, it doesn't matter really. You should be buying gold there and taking the next push up. The only question that I have while we're talking about precious metals is, why buy gold? Why don't you buy platinum or even buy silver? Because I think those two will outperform ultimately. Okay. I like platinum actually. So
okay.
Yeah.
All right. White gold for Peter Goodburn.
White gold.
Let's touch on the S&Ps, if you don't mind.
Yeah.
And we're at another decision point. We had that bear raid when no one was looking the day after Thanksgiving here in the States, and I don't know about you, I was surprised by how much we recovered in 2 days, but I also think it's so pat Okay, so now you're looking for a new high up here.
Well, I don't know whether we are getting. I mean, we've led with this as an alternate count at the moment. We had this originally as preferential, but
Right.
the thing is that Europe is looking very, very weak.
Heavy. Yeah.
Yeah,
They
I
seem
mean,
to be reacting to COVID in a different way than the U.S.
well,
That
here
is,
we've got extreme lockdowns at the moment, and there's
oh,
there's a third of the country which is unvaccinated, and they don't want to be vaccinated. And actually, today in the German Parliament, they're voting on whether or not to vote through mandatory vaccination, like Austria has. And if they do, I don't know what the consequences will be, but it's not going to be good.
you mean civil
Um,
unrest?
well, I think that so far the demonstrations have been extremely peaceful. I'm located here in Munich, which is a lovely part of the world, but right now it's very tense. And we had thousands and thousands of people out holding candles in a demonstration last night outside the mayor's house. So that's all kicking off. But one of the things which interests me very much is, from an Elliott perspective, when you're looking at different patterns across positively correlated markets. So if you want to compare the S&P to the Eurostoxx 50 from the financial crisis lows, you're seeing a very different pattern. But of course, they're positively correlated. But the amplitudes of the price gains and sometimes the corrections are different. And this is what stretches or contracts a pattern. So you've got, on the one hand, if you like, the S&P outperforming since the financial crisis lows, and that's stretching the pattern into what we call an expanding 5-wave impulse pattern. But on the Eurostoxx 50, as you can see on the screen here, this is what we call a double zigzag pattern, ABC up here into 2015, X into the pandemic low, and a secondary zigzag going on. Well, this is very, very informative, also giving us a lot of information about what to expect on the S&P. What this tells us at the moment is that, looking at our fib price ratio proportionalities, we've got a 5-wave upswing from the pandemic low, which is completed. It has completed already. We had a target here some time ago at 44.31. If I mouse over the top, it was 44.15. So pretty accurate. And, that should pull us down. I don't think we're going to make a higher high there. So if there is a possibility of the S&P trying to scratch out a higher high, it won't be for too much before it turns down again. It can't be, because this European market's already topping out. It's the same for, if you look at other European markets as well. If you can look at the Xetra DAX, or if you look at London's FTSE, they're pretty much top heavy. So the S&P, you could argue short term, it might stretch to a slightly higher high. I think we'll know about it, by the next few trading days.
Next 10 minutes.
Well, not necessarily 10 minutes today, but probably over the next few days.
Anyway, Peter, what a great presentation again. And, here's my takeaway. Instead of sitting in a lot of cash in US dollars and letting it turn into rubble, convert it to ruble. Ruble over rubble. How about that?
Barney Rubble.
Yeah, I was just thinking that. So yabba dabba do, buddy. And what a great interview. And I think that it's going to be important for the world, but Americans who sit on a lot of cash, and they may want to consider finding a place to diversify outside of the dollar and different fiat and preserve their cash wealth. And if you're nervous and you're sitting in cash, you should also diversify your cash, and there are ways to do that.
Absolutely, there are ways. Yeah,
I mean, you don't have to open an FX account. You could. I think there are many banks that you could convert your dollars into Swiss francs or whatever you want.
Absolutely. Yeah, you don't. I think the banks would be quite open to you holding a foreign cash account.
Yeah, and do that before they make it illegal to do so here, because who knows?
Well, yeah. Well, we don't know what mandates are out there at the moment. It's everything's up in the air.
Yeah,
nothing surprises me anymore, to be honest.
Yeah, there'll be foreign exchange controls if the slide gets out of hand. And, you know, some people have talked about the US will do something like France did, where they had a two-tier currency system. They gave the citizenry the crummy devalued dollar, and then had another dollar for international trade. The French did that with the franc, right?
Yeah, they did. Well, in the last few days, I have to tell you, the European Union have done a test for its digital currency. They
Okay.
claim it was a success. They finished it yesterday,
Yeah.
which is, for me, it's a little bit worrying that they pushed something through like that, because it could be the precursor to a credit system for you and me personally.
Yeah.
And the other thing is that today I see in the news, the von der Leyen, who's the EU Commissioner Chief, she's saying that we want to change the denomination of all the banknotes and change them.
Yeah.
Well,
They
a lot
did
of people,
that in India. Modi did that, pulled the high, you know, and they could do that with the $100 bill. War on cash, Peter, because cash is freedom. Even
that's
if
right.
it's depreciating, it's more freedom than a digit.
Well, I mean, if you got some cash and they accept it, that's good. I mean, here in Germany, a lot of people carry a lot of cash around for them. You know, I mean, in the UK, where I'm originally from, nobody carries cash around. It's all credit card. But in here, Germany, a lot of people carry cash around. You know, you think nothing of taking a big bundle out of your pocket to pay for a meal or a cup of coffee.
Huh.
But if she's doing that, you know, I think that there's going to be. I wonder what the mafiosi are going to think about that.
Yeah, I tell you, buckle your seatbelts for 22 is the way it looks, but major opportunities.
You score quite high on my list today, Dale, because you haven't asked me about Bitcoin.
Oh, well, you know, how can you top your call from 3,000 that you had? Where was that in 2020? Where was that 3,000 Bitcoin call?
Well, I'm just I think my colleagues here have just updated it. I think on the slightly larger term count.
Okay.
Yeah, I think this is all the Bitcoin data that there is. So
okay.
you have to in order to get something like this, you have to use a log scale chart. I mean, you can't.
Yeah,
use
it was here on 4. Where you started making, you know, we went from that 18,019 to 3, and you had these objectives that you know, kind of blew my mind. So okay, there's Bitcoin. Do you own any, Peter?
Well, I can trade it on the futures, but I don't actually have a wallet.
Yeah. So yeah, it's like, you know, watching tulips.
I mean, I wouldn't call it a currency, even though it's classified as a cryptocurrency, because it trades more like a commodity.
Yeah,
but,
what is it then?
I think it's a commodity.
Okay. So I know a lot of people say it, and this would argue differently, that it mirrors the NASDAQ. Have you found any correlation? You know, some people say gold isn't doing well because funds are being siphoned off to crypto that normally would have gone into precious metals.
Well, I mean, I think the big take is that around is that crypto is replacing gold, but I don't see it. I mean, if you talk to an Arab, gold is, you know, or an Indian person, you know, gold is king. You know, maybe the young community, but look, there's a lot of people who still wear a lot of gold in those Middle East Asian countries, even in China. I mean, it's a tangible item to have.
Yeah, Peter Bookfire says, what are you going to trust? Something that's been around for 5,000 years or something for 15?
Exactly. I think it's a good point you make. Yeah. I think it's a good point that you make there with that. And I think it's it's not, I mean, it's no point carrying a big clump of gold around in your pocket, is there? Because it's not really a tradable item if you want to. But I mean, you know, small leaves or, you know, 1 ounce
silver
bars.
coins.
Or silver coins. Silver coins are good. I think
I like them.
I think it's good to have something like that if you want to diversify a bit. Yeah, why not?
And Peter, the best way for people to follow your work, keep in touch with you, subscribe. Why don't you show your website?
Yeah, if that would be cool. I mean, if you'd like to subscribe to one of our publications, this is our website, wavetrack.com, up here. And if you just go into, where is it, registration and subscriptions, and just toggle this and go subscription, you can see one of the most popular products that we release is the Elliot Wave Compass Report. It's issued twice a week, and it's quite detailed actually, with some great forecasts in there. We're not shy of sticking our necks out, and we've got a good track record. So that encompasses a lot of stock indices, global ones, as well as US and Europe. Bonds, we're mainly updating sort of the main long-ended interest rates, 10-year treasuries, and bonds here in Europe. Good splattering of currencies on the G10 list, and then commodities, things like gold, silver, and oil. So that's just bundled up into one report. Twice a week it's published. And yeah, you can keep in touch with us that way.
Yeah, good way to prep for 2022 with Peter's accounts. And I appreciate you being here and sharing your hard work with us, having a generous spirit to do it. Hope you get some business, and I hope you have a Merry Christmas, Peter, you and yours, and a Happy New Year, and look forward to continuing to talk markets with you. Enjoy it every time. Thank you very much, buddy.
Yeah, thanks, Dale. Thanks for inviting me today, and great to chat with you too. And yeah, I guess Christmas is creeping up, the festive period. Let's hope that at least anyway gives us some respite to things. And yeah, just like to wish everybody Merry Christmas, and you too, of course. And let's hope that we have a restful time period and things are better for next year for everyone.
Yeah, that'd be great. You know, I heard someone say, Peter, I wish I would have been naughtier this year because Santa can't afford to buy the coal because it's so expensive. Anyway, no coal. We don't have to worry about coal this year. And thank you so much, Peter, for giving us a heads up on your forecast for the dollar. I think it's it could be one of the most important moves people make. You know, you could trade stocks and make money, but you really have to be aware of your underlying currency. You give away gains. If you're making money and your currency's taking a 20% hit, have you made money?
Absolutely. Then you've got to question that. Yeah, absolutely.
All right. Thank you, Peter Goodburn, everybody. Thanks, Peter. Have a great weekend. Good hunting, and we'll be in touch soon, buddy.
Thanks, Dale. All the best.
Adios. And everyone, hope you enjoyed it. Give Peter a thumbs up if you're watching the video live, and hope that we're adding value to what you're trying to accomplish in a pretty difficult endeavor. And don't forget, don't just count your pips, count your blessings. Adios. Enjoy the